Hey guys, what's up? It's Awesome Bully again with Option Traders. Today we're going to do a basic options 101, everything you need to know about options that you didn't know if you're a very starting at the beginner. If you're wondering why I look this way, it's because I have the group chat pulled up as someone asked a question. And if you're wondering why I look this way, I have a whiteboard with the stuff that I need to cover. Alright, let's get straight into it. Again, I'm coming from the perspective of a day trader, so I don't participate in any of the strategies that options can also offer. So I'm going to mention it, but I'm not going to explain it in depth because I'm not an expert on it myself. So first thing, I'm going to cover options on the TD Ameritrade platform because I know a lot of y'all probably use the TD Ameritrade platform known as Thinkorswim. So I'm going to cover it there first, and then after that I'm going to do a quick rundown on the Tastyworks, and I'll mention some stuff about the Robinhood account. So let's go into it. So when you are on the TOS platform, you want to go into the Trade tab. That is how you're going to find the options. So for instance, right now I have SPX pulled up, which is the S&P 500 index. You can, wow, is my Wi-Fi that bad? So you can pull up anything you want. So let's say you're looking at Netflix options, okay? So options, first off, you need to understand, options is a contract to buy 100 shares. Well, no. A put is an options contract to sell 100 shares. A call is an options contract to buy 100 shares. Options contracts have an expiration date. So unlike stock shares where you can buy it and bag hold as long as you want, which means you hold the shares forever because you don't want to take a loss, you can't do that with options. Options expire on a specific date. So as we can see here, this is a weekly option that expires in 3 days, so it expires this Friday. This one is a weekly option that expires in 10 days, so it expires next Friday, and etc. This is a monthly, and a monthly, and a monthly, and a monthly, and weeklies, and etc. So now let's go into it. So I'm going to click on this weekly here, because when I day trade, I want to day trade the weekly options because they're the most volatile options because they are about to expire. So if we look on the left side column on every platform, the left side column is your calls, which is basically equivalent of going long on a stock. So instead of buying the stock, you're buying a contract. So in the contract, you want it to go up. Now on the right side is your puts, so that is your contract, which is basically you shorting. But you're not going to sell to open, you're going to buy a contract, a put contract, and as the stock goes down, your put contract increases in value. So the calls are like going long on a stock, and the puts are like going short on a stock. So let's see, I want to make sure I cover what I think is necessary. Okay, so now that we have covered that, let's look at the specific price. So you have a bid and an ask. So if we look at this bid and an ask for this option, each option also has a expiration price, or what we call a strike price. Okay, so the strike price is just a number that correlates to the stock. So this is a 307.5 strike, and so you can say, all right, I picked up a call at the 307.5 strike, just to let someone know which contract you actually got. This price right here, the strike price, correlates to when you're talking about out of the money, in the money, and at the money. These out of the money, in the money, and in the, I don't know if I said that. Those three are more important and prevalent when you're trading strategies where you want to let your options expire, or like and options, there's a bunch of different strategies that you can do, such as a straddle, a strangle, a condor, a blah 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 blah, so many other things, a butterfly. So basically, let me break down a few strategies for you. I'm probably going to be wrong because I don't trade them. But a strangle is, if you buy a strangle, you make money when the option, when the stock price at the expiration date. So if you buy a strangle here, you want it in 3 days to end outside these two values and not in the middle. If you sell to open a strangle, you want to keep the stock price in between a certain level. So if you wanted to sell a strangle and you wanted to keep it in between the 290 and the 320 level, then you would sell a 290 and a 320, and that's how you would have your strangle. So if by the end of expiration, if it stays in between 290 and 320, you would make money because it would expire worthless. So strategies, blah blah blah. That's not really what I'm going to cover today. So just like stocks, another important thing is volume. So options have their own form of volume. No, the stock volume does not necessarily correlate to options volume. I know that a stock can have a lot of volume, but the options volume won't be there. And again, as every market is driven off of supply and demand, bid and ask, buyers and sellers. So if you don't have volume going into your options, then you're going to buy one and you're going to get stuck with it and you won't be able to sell it. Okay? Also, something I did not include about the expiration date is if you hold a contract through expiration date and it is not they can expire worthless. Let me explain this real quick. I'm sorry that my thing seems so haphazardous and sporadic, but this again is not scripted because I like to do it for y'all and y'all never know what y'all want. So this blue like highlighted area is in the money calls. This highlighted area is in the money puts. Now what does in the money mean? In the money means that we are already above the strike prices, okay? So as you can see, Netflix is currently 307.02, so $307. So obviously calls are going long, so obviously we are above 290 strike price already. We are above 292.5 already. We are above 305, okay? And on puts, you want to make money on the way down, so all these highlighted are the prices that we aren't that we are still under. Okay, so the current price is 307, so we are currently under 307.5. So the strike price for a put contract at 307.5 is currently in the money because it is under. Okay, so if on expiration date, if you're holding a contract and it happens to land in the money, which as we just discussed, if it's a call, it is below the current price, and if it's a put, it's above a certain price, then your option gets exercised. And since a contract is 100 shares, you have to, if it's a call and it expires in the money, you have to buy 100 shares. If it is a put and is in the money, you have to sell 100 shares. So I hope that makes sense. Now let's go back into open interest so I can start to slowly explain that. So open interest, of course, you have to have the buyers and the sellers. So open interest here, of course, if you want to change it, you just click on here, you go to basic price if it's not there, and you just add the open interest. So the open interest, which I've already made a video over, so I'm going to cover it quickly, is the amount of people that are holding a contract. So right here, if we look for this 307.5 strike price for a call, there are 346 people currently holding on to a contract. Okay, what does open interest mean? Okay, well think about it. If you want to buy something and someone has like 5 or 10 of them, versus someone who has 100 of them, who do you think you will get to buy you or sell you one? Okay, so let's say it's something precious to them. So let's say like someone has one hamburger, I don't know, for some reason, okay, versus someone who has 20 hamburgers. Who do you think would sell you their hamburger? The one person who only has one or the person who has 20? Obviously the person who has 20 is going to be more likely to give up a hamburger and sell it to you. So that's the same thing with open interest, okay? The more open interest there is, the more likely there is for someone who has one to give it up, because there's a lot. Now if there's only 2 open interests, then who the heck is going to buy or sell you your contract? I mean, you're basically stuck because they're like, I bought this contract, now I'm stuck here. So open interest is important because these are the people who currently have contracts, and if you want to buy a contract, you need one of them to sell it to you. And if you want to, well, then this goes into volume. So volume, it resets each day. So if you look up in the morning and you look at a stock and the options volume is 0, that's because it resets every single day. But the option volume is how many contracts were bought and sold in that day. So for this strike price, a strike price of 310 on calls, we had 6,163 contracts bought and sold. So if you only wanted to trade like one contract, then you could easily get in and out of 6,000. So now how does volume and open interest correlate to one another? So obviously the more amount or the larger amount of open interest you have, the more amount of volume you will have, because if there's more people who have the contracts, there's going to be more people willing to sell it, more people willing to buy it. The more people willing to sell and buy, there's going to be more volume. So obviously it's no surprise that the one that has 2,284 open interest, which means people currently holding those contracts, there's 2,284 contracts being held onto, it had the highest volume of 8,830. So how do I day trade? Because I want to get in and out of something super fast, I make sure I'm trading something that has a lot of open interest and a lot of volume for the day already. When I do that, I get filled within seconds, minutes sometimes. Well, not minutes, that's too long. Seconds, okay? When you're trading like penny stock options that have no volume with it, no open interest, you're stuck, you're screwed, okay? Like, you're gonna buy it because someone's like, yeah, I'll sell it to you, but then you'll have no one to buy it from you. You're stuck because there's no volume. So make sure there's open interest and volume so surrounded by this current stock that you're doing. So I covered that. Out of the money, in the money, and at the money. So I did not cover that yet. So in the money is the highlighted areas, and out of the money is these. Now at the money is the contracts that are sitting right at the strike price. So 307 is what Netflix is currently at. So our at the money contracts will be the 305 contract and the 307.5, because those are the two that are right next to the current stock price. So that's at the money. Now let's go into if you're going to buy a contract, okay? So if you're going to have a margin account, you still have all the same rules and regulations as you do with normal stocks. So like you have the pattern day trader rule, but I made a video on how you can get around the pattern day trade rule that I can explain to you quickly. If you have a cash account and you're trading options, when you buy and sell, your cash is immediately settled. Okay, so for stocks, if you buy some shares and then you sell that shares, you have to wait 3 days. 3 trading days until you can get access to those funds again. But with options, it settles immediately. So if I put 200 into a trade and I sell it for $250, making a $50 profit, in my cash settlements, I have $250. So the next minute, I can turn around and use that whole $250 to day trade again, and keep doing it, and keep doing it. I think TD Ameritrade has a 3-day trade limit, but I use Tastyworks, and today I did 6. So that's something else. And also, when you're buying a contract, since it's 100 shares, you take the price you have here and you multiply it by 100. So let's say you wanted to buy this contract here. It says buy for $4.30. Is it going to cost me $4.30? No, $4.30 times 100, because 100 shares, it's going to cost me $430 plus commissions. So this trade to put on is going to cost me $430. Okay, now how do options make money? Okay, well, there's plenty of ways to make money, and I could explain other ways, but I am not proficient in that. So I'm going to explain the day trading aspect of it. So if we look at a chart, Netflix for example, and we understand that, like, let's see, look, we have this little, again, I'm making this up, I don't trade Netflix often, but like, let's say that we have this little trend line here, we have this little support level here, and obviously we broke below this support level, and you want to make money on the way down. So what do you trade? You buy a put. A put is the same thing as shorting. Okay, so you would go into your trade tab, you would find one that's out of the money here, and the money. It just depends on how much you want to spend for this contract. Let's say I'd like to spend about $120 a contract, to $200 contract. So let's go here. Oh, this one is 182, or $1.82 a contract times 100. It's going to cost me $182 to buy this contract. Okay, so let's say you buy it for 182 right here. At the end of the day, you come back, or not come back, or you're watching it, and then it is now, when the stock goes down, a put increases in price. So you bought it for 182, and now it's probably worth 580. Okay, so you would make a $400 profit. So that's how this works. Options is basically like a penny stock. The way that I think about options is I think about a penny stock chart that follows another chart. So like Netflix, the options is like a penny stock of Netflix that mimics Netflix. So why do I say a penny stock? Because penny stocks are volatile and they move like crazy. You can gain so much potential gains, like huge gains, but it still mimics the Netflix chart. Okay, so like for instance, this normal move down here, like let's say if you got in here from down here, that's what? That's 2.61%. Is that right? Yeah, 2.61%. I guarantee you, on options, this was at least 100 to 200% gain. That's another great thing about options. You can take $180 and probably make a $200, $300 profit off of it. Again, it is not normal to have this huge drop. We all know it's not normal. We usually have some consolidation or something, but still, I've seen a day where someone made, or I watched a contract increase in price by 3,000%. Let's take 3,000%. Yeah, that's just crazy. Okay, so that is how you would buy a contract. You would go in here. The best thing to do is put it at the mid price. So again, you have your ask, well, your bid and your ask, and they're usually off by about 10 cents. So you would just bring it to the mid price and see if you get filled. And if you don't get filled, then move it to the ask. So again, that's basically what I use in options. I'm not a guru, I'm not an expert. I just know enough to be able to trade the way that I trade. I day trade them, so I'm not in contracts much longer than 5 minutes, 10 minutes a day. I mean, the past 2 days I've only been in a contract for 2 minutes, and I've made 11% on Monday and 10% today. So it's not that bad. Again, in my description is an options trading Discord group. There's a Facebook group. There's everything that you will need. You can also cruise my YouTube channel. It has my strategy and what I do and other stuff about options, like options pinning and max pain and all that good stuff. I'm constantly adding to this YouTube channel. So please like, comment, and subscribe. Again, if you don't like it, put a dislike and then tell me why, because I want to know that. And I will also link below Options Alpha and Tasty Trade, and a few other good places to learn all the basics of options for free, because again, I don't use options to their full capacity. I just know what I need to know. So I hope this helped you learn something if you didn't know anything, and if you did, I hope it still taught you something. Alright guys, thank you for tuning in, and I hope you learned something great about options.